All right, well, welcome again to the class. So a couple announcements. I just got to make sure I don't forget. The one thing that I should remind everyone, or if you don't know, the Center for Entrepreneurship and Technology sponsors the Technology Breakthrough Competition on behalf of the College of Engineering. And what we're looking for in this competition is technology that you're working on, or concepts and ideas that have commercial potential and have basically value, that even if you're not sure in which way exactly it would be commercialized. It's very simple to apply. It's only a 2-page application to apply to it. It's really a nomination for the technology. So just a reminder that those nominations, if you're planning to do it, are due on October 20th. All right.
What's the IP considerations?
So the question is, what's the intellectual property considerations? And our intention is to leave to have a no change in IP status. So if you own it, then you still own it. It doesn't change it. If the university owns it, the university still owns it. And if you're about to file some sort of provisional patent or something like that, and you feel that this would mess this up, then don't apply. Basically, but it's only a disclosure question. If you feel that you can share it, then share it, and it doesn't change anything after that. I think, okay, yes, you can submit multiple applications, okay? Check our website, and I'm sure you've seen these posters around. All the rules are posted. Just a quick question. Who has actually done an interview with a source member so far? 2. Is that it? All right, well then it's probably a little too early to ask how it's going. So we'll wait. Maybe I'll ask you that next time, or next time after that, or however long it takes. Anyway, it's now time to introduce our speaker, and we are very honored to have Peter Wolken with us. Peter is the founder of AVI, which is Associated Venture Investors, and that was in 1982, which an early stage specialized in early stage and seed investments. He has a long list of successful new ventures, new companies, including Extreme Networks and Network Peripherals. He's a Berkeley alum, particularly bachelor's in mechanical engineering, and he also has a master's degree in international marketing from Thunderbird. With that, I'd like to introduce Peter Wolken.
Thank you, Iklak. I wanted to start off here with a little light humor. I got this email today that said Willie Nelson, maybe you saw this, got caught with a bag of marijuana. And he said, the good thing it wasn't a bag of spinach or I'd be dead now. So anyway, what happened to the light? The light went out. What do I have to do?
Periodically, yeah, we're going to have to.
Oh, okay. Just touch something. Magic. It comes back on. All right. So we're going to talk for 30, 40 minutes?
Yeah, and everyone's still here. I'm afraid.
You hear okay? Okay. Louder? Who's got the switch? Turn up the volume. Okay. All right. Testing. 1, 2, 3, 4. Oh, mic. Move the mic up. Okay. That'll work better. Okay. I normally speak loudly, loud enough. Okay. Good. All right. So I want to leave time for Q&A afterwards. We have like 20 minutes of Q&A afterwards? Yeah. Okay, good. So I'll try to go through this fairly quickly. The PowerPoint also will be available on the website.
It will.
Yeah. So, you don't really need to take notes, but write down your questions, because I think you'll learn the most by asking questions as we go through this. So, investing in innovation and entrepreneurship. I'm really honored to be here today because I graduated here in 1958. Not quite 50 years ago, but pretty close. And I managed to get through school and graduate. So, innovation. Actually, this slide should be called imagination. And I think it's important to think about imagination when you think about innovation. I'm going to go through a little bit about my experience so you know where I'm coming from. So I went to Cal, I got out in '58, I went to Thunderbird and took 1 year in international marketing. Got hired by RCA International Division in New Jersey and New York, and I went on a management training program in 5 or 6 different divisions and learned a lot about electronics, and also at that time computers were getting started. Then I didn't care very much for the East Coast. I moved back to the West Coast, worked for Beckman Instruments Systems Division where we marketed and built wind tunnel data acquisition systems. This was really something I liked because I was a mechanical engineer and I liked aeronautics, and you know, it was fun. I also learned how to support the sales manager. Then I wanted to go back to Europe because I had done that when I was in the Army, and I didn't stick that in here, but along the line, before I finished up at Cal, I spent 2 years in the Army, and 1 year of that was in Europe, and so I kind of got the international bug. So General Electric was looking for field engineers to go install and turn over to the German and American Air Force a command and control system in Germany. Pretty big system, and I worked on that for a couple of years, and it was pretty interesting. When I came back, I had some experience in Europe. I wanted to do something interesting with a lot of upside, and I ran into 2 Germans and an Englishman who started a company called CoBuild. And a year later, we merged with Computer Vision, who became the world leader in mechanical CAD. That was a very gratifying experience because we traded the CoBuild stock for Computer Vision stock. They were a high flyer, went public, and did quite well. Then I was enamored with the technology of electron beam lithography and ETech, which is over at Hayward, later was acquired by Applied Materials, built this very complex system for making photomasks, the tooling for the semiconductor industry. And after a couple of years with ETech, I had the opportunity to join with a group of industry people in Page Mill Investment Company, which was an angel fund made up of a dozen or so individuals, the management team of Hewlett-Packard, Bob Noyce, the founder of Intel, the CEO of Fairchild Semiconductor, founders of Rohm, and a few other people. And we spent 2 years looking at early stage, low capitalization deals because it was a very small fund and it was just our own money. We didn't have any institutional investors. And we made a dozen investments during that period of time, and it worked out pretty well, and I thought this is a good business, so I started AVI in '82 and raised a series of 3 funds, AVI 1, 2, and 3. Then my friend Ken Levy, who's the founder and chairman of the board of KLA-Tencor, asked me to set up a corporate venture fund for them, and I did that. And did that half-time while I was also asked to help Diamond Head Ventures start up a fund. And so I had several half-time jobs and kind of thought it was time to scale back. And so I taught a class in entrepreneurship at Carnegie Mellon West, and then have been helping my graduate school, Thunderbird, with annual conferences entitled The Globalization of Private Equity. So that's kind of what I'm doing now. It's a long tail. Track record, my biggest winner, I believe, was Extreme Networks, where we invested $4.2 million. This was in AVI 3, returned 125 times that to our investors by distributing the stock, and it doubled again in the aftermarket. So I had a lot of friends, based on that one. Also, Inverse Network Technology was a good return, 19x. Grand Junction Networks, the excellent return, was acquired by Cisco. And my career total of deals that I was really the point man on, 40 million invested, 654 million returned, or a multiple of 16.4x. And here's some of the companies. Some of these you might not recognize, but a few you will, perhaps. And Microchip, down at the bottom, was an interesting investment. Steve Sanji, who came out of Intel, took over the old General Instrument semiconductor plant in Chandler, Arizona, and turned it around and became, over a number of years, #1 in the world in microcontrollers. Microcontrollers are the low-cost chips that control and power almost everything and cost about $1 a piece. They're in all appliances and automobiles, and so Microchip now builds about 1 billion of those a year, and turned out to be a terrific company. My cost basis was 7 cents. Current price, last time I looked, was about $35, so one of my better deals. And in terms of the ranking, somehow this got screwed up when we went from the PC to the Apple, but it's IRR, the first fund was kind of so-so. Second fund, we were the highest rate of return, 32% compounded per year for 10 years, and the third fund, second highest, 130%. So this one, I kind of thought that Moore's Law was very interesting, and that semiconductors double in terms of the number of transistors on a chip every 18 to 24 months. I noticed that the speed of the Ethernet increases by an order of magnitude about every 7 years. And it was developed by Bob Metcalf at Xerox Palo Alto Research Center in 1973. Then 3Com, which the company he founded, came out with a 10 megabit Ethernet. Then Grand Junction came out with 100 megabit, and Extreme Networks came out with a gigabit. It's a little hard to read, but that says 10, 100, 1,000. Extreme Networks also has 10 gigabit Ethernet, and I noticed that there are several companies developing 100 gigabit Ethernet, which should be available by 2008. So interesting progression. There seems to be insatiable demand for speed on the Ethernet, on the internet, in computing. All of that speed led people to jump into venture capital in tremendous amounts, and we all recognize that there was a boom. And that happened, and then there was a bust. After what's called the dot-com bust, venture capitalists became very conservative, and limited partner investors, institutional investors, became very conservative about investing in venture capital funds because the returns kind of went away. In fact, for the last 5 years, the average return on venture capital funds is negative. That's enough to scare away a lot of people. But there's a lot of optimism. It's coming back. And as you can see, during that period of 96, 97, the returns were running 80% per year. It's possible that they'll get back up to very good returns again. In fact, although it tapered off, it's swinging back now. 8.4 billion was invested in the second quarter. Average was 5.5 billion a quarter last year. Up from 4 in 04. And during the boom time, U.S. venture capitalists invested 106 billion into 8,100 deals in 2000, which obviously was way too much money and too many deals, and a lot didn't work. But we are now back to where we're at the highest investment level since 2001. And although we may never approach this peak again in the near term, it's moving back up. Number of deals is reasonable per year, and the amount of money being invested is moving up to pretty healthy numbers. If you forget the peak, the spike in that, it's a pretty smooth progression. 22 billion last year. And the amount paid in M&As now surpasses 2004. This is important because venture investors look for liquidity. They invest, they expect that they can return to their investors a multiple on their investment by either taking a company public or being acquired at a nice price. There was a recent acquisition you all know about. It was a rather nice price, 1.6 billion for a company with no revenues. So, you know, that'll move the statistics up a little bit. Yeah, right. So that's a great example, and it's wonderful that we have a company like Google that can do those kind of acquisitions with a very small percentage of their market cap. So some of the objectives of entrepreneurs are learn the skills required to build a business. The guys who are interviewing me are interested perhaps in, after graduation, learning some of these skills while working for an existing good company that makes a profit, and you can learn a lot by working for a profitable company. And there are skills required to form a team so that you don't just have a couple of inventors, but you have marketing people, sales people, finance people, sometimes manufacturing people, and you need to build a world-class team. Selecting the opportunity, we talked about market-driven needs, and I'll go into that a little bit more. Preparing a business plan and a presentation, it's pretty vital to make sure that that's well done and well rehearsed. And then it's possible to raise venture capital. And there's a lot of it out there, but it's not for everybody. And then penetrating the market. So once you have the idea and the capital and you build a product, you've got to sell it and grow a profitable enterprise. So some highlights of what I'll touch on here is defining innovation, talking about some of the success patterns in Silicon Valley, why here, why now, and what is your vision that will succeed? Will others share your vision? So innovation, defined by Webster as to introduce something new. Some reason people like new sells. Forget about the image of the lone, misunderstood inventor toiling away in obscurity, because innovation doesn't just happen. It takes time, effort, and hard work. People who are enthusiastic about company goals have the best ideas. And I mentioned to these guys who were interviewing me before this, the fuel that startups run on is enthusiasm. You need a team that has the belief that they're going to do it. So inspiration may be the mother of innovation, but it isn't enough. Ideas must stand the test of reason. Is it real? Can we win? And is it worth it? I went to a seminar for 2 days some years ago, and the whole session for 2 days was, is it real? Can we win? Is it worth it? Drilled it into my head about the market, about the product, about every aspect of building a business. So you are all familiar with the top 12 Silicon Valley tech firms, but I thought I'd put this together because a number of these companies were startups not too long ago, and their success in terms of market cap, right, the total value of the company on the stock market has been pretty outstanding, with Cisco in the leadership position of 150 billion and Google right on their heels with about 130 billion. Intel, Hewlett-Packard, Oracle, Genentech, Apple, eBay, Yahoo, Gilead Sciences, that's the only life sciences company in the group, Applied Materials, and Adobe. And those ought to all be pretty familiar names to you. So what is the vision that will succeed? There will be many, and some will be better than others. And so as entrepreneurs, it's necessary to try to pick the best. Focus on large, underserved markets, find an unfair advantage, build a world-class team, and plan for this to be a long-term project. Today, from startup to liquidity to the average venture takes 6 years. It was in that range when I started in the business, 5 to 7 years, we used to say. And then people thought that it ought to get shorter and shorter and shorter. One day I had some guys from Berkeley, I think, came down to my office, and they were doing some kind of a .com video game, here today, gone tomorrow thing, and they said, yeah, this is going to be great. We're going to have it out in 6 months, and then we're going to go public 6 months later. And it's kind of unrealistic. I won't go into all the detail of what it takes to be a public company, but 6 years is a fair estimate of what it might take. I funded a company out of UC Berkeley. The first test was at Corey Hall called LGC Wireless. That was the initials of the founders. And their idea was good, and the company is now 9 years old, and it's still private. Been making steady progress up to about 40 million in revenues. But investment bankers these days would rather see 100 million before they take a company public, and what they really want to see is consistent profitability. So why is this working so well in Silicon Valley? Major universities like Cal, Stanford, Santa Clara, San Jose, CMU West, high density of technology companies, must be the highest in the world. At one point, I think we had 8,000 or 9,000 companies, and availability of excellent, experienced people who have the willingness to work hard and the enthusiasm and perseverance to believe they can make it happen. Lots of low-cost space available, and climate best by government tests, plenty of venture capital. This is a pretty nice statistic. Of the top 100 fastest growing technology companies, 41% are in California, or 41. 10 in Massachusetts, 6 in New York. So about 2 out of every 5 deals go to California. With Bay Area, clearly the biggest segment. And then New England is a runner-up behind that. Some in Southern California. The rest is kind of fragmented across the country. So we have, I think, in our area, what US VCs want. But specifically, they want world-class teams. And that requires experienced people who have proven that they know what to do. Innovative technology, serve market-driven needs or solutions for pain. And I talked earlier about the fact that market validation is extremely important, where you have to test your idea on prospective customers to see if they really believe that they have a need. And those prospective customers can help in the product planning. Aggressive marketing plans, low burn rates. Burn rate is the money that you spend every month in a startup company, and where there are no profits, there's only cash being burned until there's no more left, and you have to go raise more. You know, it's all over the place. It depends on the size of the venture, right? But you know, I would say less than $100,000 a month is, you know, considered to be low. And you know, when it gets to be $1 million a month, it's awfully scary, right? And so, and even way under 100,000 a month for new startups. So it depends on the maturity of the startup. Profitability within 3 years is a great goal. and not easy to achieve, and positive cash flow shortly thereafter. So why now? Well, timing is always good for the right venture. Another inflection point is reached as the economy recovered from bursting of the bubble, and new high-performance components are coming. Internet penetration is very great worldwide, and wireless device market is still growing. It's the #1 consumer product with huge quantity of new wireless devices being sold worldwide every year and new features being added. So will others share your vision? You test it out on friends, colleagues, teammates, professors, and prospective users especially. Market validation is vital. People used to say, if I build it, they will come. That's not the way to approach it. Test it first to see if you build it, do they really need it? How much will they pay for it? And how long will be the sales cycle? Because during the time where you have a sales cycle, maybe 6 months or a year, you're burning money. On international ventures, US is still the primary market, with Europe second and Asia rising quickly. China has been very good at emulating US successes, and India is developing extensive software skills and partnering with a lot of US companies. Eastern Europe markets are becoming competitive also as software partners. So VCs are beginning to invest globally. They were surveyed by Deloitte here earlier this year. They published this report that over half said they will expand internationally over the next 5 years. But so far, this looks like less than 20% is actually being invested outside the United States, with the biggest pieces of the pie: China, UK, Canada, Israel, France, Germany, India. UK and France represent over half the deal flow in Europe, and you know, it's no secret that Germany is also a very big country with a lot of activity, but not so entrepreneurial. So some of the avenues to growth I've listed on a couple of slides here are all kind of obvious. There are plenty of opportunities still in software and communications and networking, medical devices, biopharmaceuticals, semiconductors, electronic hardware, consumer products, energy and clean technologies, information services, and new materials. When asked about how they're going to go about investing globally, the venture capitalists responded they're going to ask their partners to travel more, develop strategic alliances with foreign-based firms, invest only in those that have a local presence, hire staff with expertise in target countries, open new offices, require their partners to transfer to the foreign locations, and relocate certain partners' portfolio companies to be near the firm. Dick Kramlich spoke to a group last week. He's the founding managing general partner of NEA, New Enterprise Associates. They just raised a $2.5 billion fund, and they are starting to invest in India and China together with partners. So I put down a few things here, recommended reading. Jerry Weissman put together a little booklet on presentations that win. He is a favored consultant for lots of companies to tutor the CEO and CFO before they go on a road show to raise their money or take the company public, and really did a good job in his book. I'm currently reading the 5 Disciplines for Creating What Customers Want by Kurt Carlson, who is the CEO of SRI International, formerly the Stanford Research Institute. Very good book. And then this Global Trends in Venture Capital is very interesting and available online. I thought also an example of a fantastic presentation is this Inconvenient Truth that Al Gore did. How many people have seen that? Not very many. I recommend it. You know, whether you believe in the premise or not, he does an absolute magnificent job of putting together a presentation with all kinds of multimedia things, and very good speaker, very, very good example of a great presentation. I like this. My neighbor is Chinese, and she drew this character for me when I went to give a talk in Shanghai at Fudan University, and she also taught me, anybody here speak Shanghainese? A couple, yeah. She taught me how to say, follow your dream in Shanghainese, and I got a big kick out of that. Sei cho nong gamung, sound right? Well, my accent isn't perfect. So, I have contact info, and I put up one new slide, which is in the news today, hottest startup since Google, worth 1.6 billion, or is it just another company in need of a business model? I think Google will figure out how to apply a business model to that acquisition, and pretty amazing. Okay, well, let's take some questions. Go ahead. I'll repeat the question. Okay, try to make the questions short if possible so I can remember how to repeat them.
You said learn skills to build businesses as your first entrepreneurial objective. How did you do that?
How did I do that? Well, when I was going to Cal, I started a company making shoji. Oh, excuse me, I didn't repeat the question. Yeah. How did I learn business skills? I guess I was always somewhat entrepreneurial, so when I was going to school to make a little extra money, I started a company. There wasn't really a company. I built shoji screens out of wood frames and rice paper. And you know, I did a bunch of little projects like that, trying to understand what it would take to build a product and sell the product. But the way you get those skills really is by working for someone who's a mentor, who can really teach you various aspects of skills in business. Next question. I'll try to remember to repeat it. Yeah.
How can students go about building a world-class team?
How
How can students go about building a
can students build a world-class team? Well, the Google guys did it. I think it's rare that students will actually build a world-class team to start with. And what usually happens is they're asked by their investors, assuming that they get some investors, to bring in what is called adult supervision. And these are managers who've done it before and who can help their people develop those skills that you talked about, learn, get the right kind of experience, organize them in such a way as to be effective. But I think in most cases, students will get skills by working for an existing company first to kind of learn how it works before doing a startup. But there are exceptions, and I mean, Google is probably the greatest exception in the world. Yahoo was very similar, both funded by the same guy, Mike Moritz of Sequoia Capital. May have had something to do with YouTube as well. Yes? I don't hear too well, so you got to speak up.
What's the best way to leverage the university resources that we have at Cal? And like, what's the kind of steps do we take in that direction?
Yeah, that's a very good question. So how do you leverage the university resources here at Cal if you wanted to work on a project at starting a business? I've gone over several times to Haas Business School, and they have business plan competitions, and they have tried to get the people in the business school to find people in the engineering school to work with on projects. So that's the semblance of a team. Somebody in a business school trying to understand, is it real, can we win, is it worth it? And somebody in the engineering disciplines say, we think we can attack this problem and be successful at it, and convincing each other that this makes sense, so kind of forming a partnership. I think that's one way to do it. Iglock said there are intellectual properties that belong to the university that are available for licensing also. And there is a way to work together with them on those kinds of projects, because there's a lot of research done at the university which is really at the R&D level and not ready for commercialization yet. And a lot of those people would rather just work on the research and get someone else to work on commercialization. So there's a transition there that some people can work on. Timing is everything, having the right thing at the right time. Question?
What made you cross the bridge between wanting to start ventures and wanting to fund ventures?
Yeah, well, I didn't know anything about funding ventures, but my friend Ken Levy told me there was an opportunity to work with these senior executives from these great companies, and they were looking for somebody to go out and be the bird dog to find the targets and then bring it to them and ask them, what do you think? And it was a great learning experience. So I learned working with a dozen different mentors who are great industry people. It was a fantastic opportunity. I just fell into it. Yes?
In today's environment, how do you separate the Me Too's from the real deals? How would you have separated YouTube, say, from the thousands of other video sites that are out there?
Yeah, a good question. So how do you separate the Me Too's from the real innovations that are going to win? That's a $64,000 question. That's really, really tough to do, and you don't get it right every time. So venture capitalists who try to recognize talent and vision and don't get a chance to talk to everybody that's in that particular field, but the ones that they do talk to, and they may have a chance to talk to a few in a particular field, they would like to be able to pick out the ones most likely to succeed. They do that a lot by trying to evaluate the people, because in the final analysis, the ideas might be the same or similar, the business plans might not be too different, but the people behind it are the ones that are going to make it work. And so they try to evaluate the people, which is the hardest part. Are these people willing to work hard enough? Are they really dedicated? Do they really have what it takes? And it's like the old story of the guy, you probably heard this, but it's a good one, about the two guys are in the woods and bear is chasing them. You know that one? Well, one guy stops to put on his running shoes, and he says, are you crazy? You can't outrun a bear. He says, I don't have to outrun the bear, I just have to outrun you. So you don't have to be perfect, but you got to beat the competition. Okay.
So if we don't have a world-class team right now, should we focus on finding that team, or should we focus on approaching the VCs and having VCs bring in management?
Yeah, that's a good question. If you don't have a world-class team to start with, which few do, can you approach the VCs ahead of that and have them help you? Absolutely. So, they feel, in general, that they can add value. And the best way they can add value to early stage venture is to help recruit management and bring in experienced guys, because they have a network or a stable of people that want to go to work for startups that have great upside potential. And they'll introduce you. But you need to be ready, because a world-class CEO, even a potential world-class CEO, is not likely to jump in a startup that has an idea with some young guys with very little or no experience and no money. I mean, you know, they may be entrepreneurial and they may be adventurous, but they're not stupid. So if they're going to change jobs, they would like to go somewhere where maybe there's already some capital been invested so as to minimize their risk. In the old days, you could get guys that would jump in and say, I can do it, I'll raise the money, don't worry about it. And today, they're a little more skeptical. And so that's usually the big issue is, can we recruit a CEO? And it takes some time and some development. Question. Sure.
Okay. In your slides, you said this year there's something like $23 billion in venture capital invested. And you were saying that it's more than last year. Basically, that more and more is being invested every year. But how much of that is going to the early stage things? And could Google or Yahoo or similar companies, which are student ideas really, be invested in markets today? How likely is it that if Google was looking for money today, they would pick up funding? Because they had enough trouble in the peak. Honestly, Google had a lot of trouble getting, they were passed by a lot of people at that time.
Well, the guys who put up the first $1 million took out a few billion, so they're pretty happy.
Yeah,
but,
I met Michael once.
Yeah, but he didn't put up the first $1 million. That was Andy Bechtolsheim, Ram Shriram, a few other guys.
Right, okay.
And a $100,000 investment by Andy Bechtolsheim became worth over $2 billion. So those guys, you know, they were very adventurous and venturesome and willing to take risks. So the question really is that there's 23 billion or 30 billion, whatever it will be. It's still a small amount of money compared to how much is going into leveraged buyouts. So that's another field, but this is institutional investors putting money into funds that buy existing companies and are willing to pay 10 or 15 or 20 billion dollars for those companies because they leverage it with debt. It's a different world, but it's like 10 to 1. So the venture capital money, although it's 30 billion, is a nice size and growing, how much goes into very early stage? Now, I would say, I don't have that number off the top of my head, but it might be 20%. It might even be less. It might be 10%. A lot more deals, but the average small size per deal. Dick Kramer gave his presentation. He just raised $2.5 billion. And we said, how can you invest $2.5 billion? He said, well, we're going to put $1.5 in expansion financing. You know, companies that are already making progress and looking for quite a lot of capital. But we're going to take $1 billion of it and put it in startups, early stage. That's a lot of money. That's 50 startups at 20 million apiece. That's a lot. But you know what they do is they allocate 20 or 30 million over time. It doesn't go all in at once. It goes in stages. Series A, Series B, Series C. As long as the company is making progress and people are willing to invest more money at higher valuations. How about the back of the room there? I noticed somebody sleeping before. I used to have, when I taught a class when I was in the Army, I throw chalk at the guys who slept there. They all sleep in the Army. They're so tired from working out. Yeah.
You seem like a warm person, and I wouldn't mind asking a question now. But if I had an idea and I wanted to contact your office, pitch it to you, how would I do that from my position?
Yeah. I mean, you're Superman, right? So you fly in. You fly in. It's very compelling with your, you know, entry. How would you approach?
Well, from what I've seen in like documentaries, VCs can be very intimidating to.
Intimidating.
They can be
Yeah. But, you know, there are all kinds of people out there, and some are very friendly and very helpful. Some are so busy that they are short on patience. You know, they don't have a lot of time, or they're not willing to invest a lot of time with people whose ideas are not fully baked, right? And they need help. So a lot of times, angel investors, made up usually of industry people who've been successful and are willing to take some of their net worth, sprinkle it around because they believe in the system and they want to help young people. They are probably the best path to go to first, to raise a small amount of seed money from individuals and get some help. So, you know, I think if you're talking about going to talk to some of the large venture capital funds about raising a lot of money and you're not ready, you don't have your team together, you don't have your act together, you expect to be turned down. So, I mean, it's necessary to be prepared. Question?
Well, how can you build a team when you have no money?
How can you build a team when you have no money? It's called sweat equity. There are a lot of ventures that are formed with little or no money. The people use their savings, they moonlight, you know, they're working part-time. There are all kinds of ways to do it, but you're right that building a real world-class team over time is going to take capital, and that's why, you know, you need to raise some money, but it doesn't have to be a huge amount to begin with. The one company I've been working with for a couple of years is finally raising their second round, and they're closing on Friday on $2 million of a $4 million financing. And I asked the CFO today, I said, where's the other $2 million coming from? He says, I don't know yet. And they've been working on it for a long time. It's not easy to finance. You know, this one has a very experienced CEO, founder. He's probably too experienced. He's not quite as old as I am, but close. And you know, people kind of look for this experience and also stamina, youth and enthusiasm and experience, you know, so kind of in the middle layer for management that still hasn't made so much money they don't need to work hard. And people who are turned on and willing to work hard. So you got to get the right mix of that team. That's all important, is team building.
I think we got time for one more question.
Okay. How about the Google guy back here? What? How much equity would I take? It depends on, okay, if I were to provide seed financing for a new startup, how much equity would I take? So most people today kind of think in terms of value for value, and it depends on how much you raise. But let's just say, for example, you raise $2 million, right? And that's not a huge amount of money today, but it's significant. So that would probably buy between 40 and 60% of the company, right? And so that leaves 40 to 60% for the founders and employees. But you have to schedule the fact that you're probably going to need to raise more money in the future, so there will be further dilution for the founders and employees. If you can create value fast enough and high enough, that dilution will be minimized. And that's up to the team. But you know, today people expect a pretty significant amount of equity for the risks they're taking. Because, you know, if you really think about it, most of these startups fail. I hated to hear that. I was fundraising one time in Japan and trying to raise money from this guy, and he said, yeah, I know, Silicon Valley, most of the companies fail. I didn't believe it. Sometimes you don't listen, right? You just go ahead and say, well, that's the other guys. Recently there was an announcement that one of the better venture funds decided to give the money back and not proceed with their 10th fund. They're headquartered in Texas. And I was sad to see that. But I think they felt that it's very difficult now to get companies public. They already have a big portfolio. They know how difficult it is. And they thought maybe it's not time to raise another fund right now. So, every group has to figure it out. They have to show the results to their investors. And that's track record. And it's been very difficult the last 5 or 6 years. But they're willing to take risks. And it's a lot of it has to do with this building rapport, because it's like a marriage. There's people, they happen to have raised money, so that's their job, is to invest the money. And you have these entrepreneurs who have some great ideas and they're looking to form a partnership. That partnership might go on for 10 or 20 years. It's really long term, right? It's certainly, on the average, going to take at least 6 years, right? It's the minimum. So, when you're going to have that kind of relationship, you have to build a relationship of trust. And in order to get the money from the institutional investors, the venture capitalists had to do that. He had to go out and build a relationship of trust, because he said, trust me, invest in my fund. I can't tell you what I'm going to invest in. I can't tell you that I'm not going to lose your money, but I'm going to try to do the best job and make a profit. And they have to build that trust. Not easy. Okay, well, thank you very much for coming. We actually, thank you. Kind of filled up the room just about, so I'm impressed that quite a big group. And you guys have a lot of speakers that are scheduled, so it's a good program. I'm honored to have been chosen to be part of it. Thank you, Clark.
Thank you. It was very nice.